Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Hey everyone and welcome. If your business operates in more than one state, you already know the tax landscape is always changing. So we're going to break down the most important state tax updates from November 2025, the stuff you absolutely need on your radar.
It's a full-time job just trying to keep up, right? Every single month, there are new rules, new court cases, new deadlines. So the real question is, what actually matters for your business right now?
Well, that's what we're here for. We've sifted through all the noise to bring you the key developments that are actually going to hit your bottom line. Let's dive right in.
First up, we're jumping into the world of income and franchise taxes. We've got some pretty significant moves happening in 4 key states you'll want to know about.
Let's start in Colorado. There's a really valuable tax credit for businesses that's on its way out, and you're going to want to pay close attention to this deadline.
So here's the deal. It's all about the timing. Right now, you can claim a nice refundable credit on the property tax you pay on that first $18,000 of your business personal property. But, and this is a big but, once that calendar flips to January 1st, 2026, poof, that credit is gone. This is a critical piece of info for anyone planning their tax strategy in Colorado for the next couple of years.
Next, we're heading over to Delaware, and this is a classic story of state versus federal tax policy. Delaware has decided, you know what, we're going to do our own thing.
And that brings us to this key idea of decoupling. So you know how a recent federal tax package changed the game for things like R&D costs and bonus depreciation? Well, Delaware has basically said no thank you. For their corporate income tax, they're sticking with the old federal rules. States do this sometimes to keep things predictable for their own budgets and, frankly, for the businesses that operate there.
Now over to New York City, where we've got a story that ended with a huge win for a taxpayer. And this sets a really important precedent for a lot of other businesses.
Wow, you can really feel the court's frustration in that quote, can't you? The whole case was about whether interest expenses you can deduct on your federal return are also deductible for the city's unincorporated business tax. The city actually argued they weren't, but the tribunal just completely shut that down. They saw it as a massive overreach, and this ruling really reinforces that federal rules should, actually apply.
All right, let's head down to Texas. The state is trying to clear up its rules for taxing businesses that don't have a physical storefront or office there, and this all comes down to a concept called economic nexus.
So what the heck is economic nexus? It's pretty simple, really. It just means that if you have enough economic activity in a state, like, say, a whole lot of sales, you've got to pay taxes there, even if you don't have a single employee or office on the ground. Texas is now looking to fine-tune exactly how they measure that activity for their franchise tax.
Okay, let's shift gears. Next up, we're talking gross receipts taxes, and we've got some important final rules coming out of San Francisco and a really interesting court case from Washington.
So in San Francisco, the city has finally locked in its own rules for sourcing receipts. That's just fancy talk for figuring out if your income should be taxed there. Like the state of California, they use what's called market-based sourcing, meaning taxes based on where your customer gets the benefit. But here's the key difference you got to watch out for. San Francisco has a very specific rule for sales of financial instruments, tying them to the customer's location. It's a small detail, but for financial firms, it's a huge deal.
Meanwhile, up in Washington state, a mortgage lender got some mixed news from the Board of Tax Appeals. The good news? The board said lender credits paid to a borrower can be excluded from the B&O tax. But the loan level price adjustments and guarantee fees? Nope. Those were considered part of doing business and are taxable. This is a super important distinction for lenders trying to calculate what they owe, because every single line item matters.
All right, for our last section, we've got a rapid-fire round of updates for you. We're going to cover everything from international sales tax to property and transfer taxes.
We'll hit a new compliance program in Washington, a really fascinating property tax case from West Virginia, and a taxpayer-friendly ruling on mortgage taxes down in Florida.
First, Washington is rolling out the welcome mat for international businesses. They're offering a temporary program to encourage foreign remote sellers to come forward, get registered, and get caught up on their back taxes. So what's the deal they're offering? Well, first off, the window to get in on this is really tight, just from February to May of 2026. But the big carrot they're dangling is potential relief from penalties and a limited look-back period for those unpaid taxes. This is Washington making it very clear they are serious about compliance from sellers all over the world.
Now for a number that tells a really interesting story. 35%. Let that sink in for a second.
That 35%?
That's the reduction in a natural gas pipeline's property value, which was just upheld by a West Virginia court. The pipeline's owners successfully argued that the pandemic created what's called economic obsolescence, which is basically a technical way of saying that huge external market forces made their asset way less valuable. It's a perfect example of how real-world events can directly change your tax bill.
And last but not least, down in Florida, a court handed a win to a bank that's also great news for homeowners. The court said that when you refinance a mortgage, the state's doc stamp tax is only due on the new cash you borrow, not the original loan amount you're just rolling over. This is huge because it prevents a kind of double taxation on the very same debt.
So, after that whirlwind tour through state tax news, what are the big picture takeaways? What does this all mean for your business? Let's connect the dots.
4 big themes really jump out. 1, the tug of war between federal and state tax law is only getting more intense. 2, the rules for taxing remote businesses are still very much a work in progress. 3, courts seem more and more willing to look at real-world economic impacts, not just the black and white letter of the law. And finally, number 4, states are laser-focused on compliance, especially when it comes to remote and international sellers.
And that leaves us with one final thought. The rules are never standing still, and staying on top of them isn't just about avoiding penalties, it's about smart strategy. So the question is, are you adapting as fast as the laws are changing? Thanks for joining us for this explainer.